Hello and welcome. So, this is chapter 2 of the book review. We are going to discuss in this chapter what is money management all about. So, money management strategies, financial statements, and budgeting. So, financial statement, we are going to discuss what is a balance sheet and what is a cash flow statement, how to prepare a balance sheet, how to prepare a cash flow statement, and how to analyze them. Then, we are going to discuss the process of budgeting. So, planning for successful money management, day-to-day financial activities that we have necessary are necessary to manage current personal economic resources while working towards long-term financial security called as money management. So, money management is important for your current obligations as well as your long-term financial security. Daily spending and saving decisions are at the center of financial planning. So if you spend more today, you would have less amount saved for tomorrow. If you save more today, you will have more amount for tomorrow. So coordinating these decisions with your needs, goals, and personal situations are important. So we have to see everything together. So inflows and outflows that you have right now, the expenses and income that you have right now, and how do you match it to your needs, goals, and personal situation. Maintaining financial records and planning your spendings are essential to success. So, if you're not maintaining financial records, you don't know whether you're doing it right or whether you need to change something about your spending habits or about your saving habits. So, maintaining financial records is of utmost importance. So, there is a concept of opportunity cost and money management. So, spending money on current living expenses reduces the amount that you can save and invest. So, if you spend more today, you have less amount for tomorrow. Saving and investing reduces the amount you can spend now. Same way, if you save more today, you have less amount to spend today, but you have more for tomorrow. Buying on credit ties up your future income. So, if you take on any loan, you can use that amount to buy something today. You can use it for your current expenses. But what would happen? That loan you would have to repay it in future. So when you start repaying that loan, your future income will start reducing. Using savings for purchases result in lost interest earnings. Savings can be used for other purposes. So if you use savings for purchases, so you withdraw amount from your savings account, that amount will not get any interest. So you lose on interest. Comparison shopping can save your money but uses up valuable time. So if you're smart about your shopping decisions and you go through a lot of websites and a lot of physical stores before you make that decision, you're doing the right thing by saving your money. But the opportunity cost for that is you give up on time. So the major money management activities is storing and maintaining personal financial records and document. So know what you are doing. Create personal financial statements. So balance sheet and cash flows. So we'll discuss what is this all about. And creating and implementing a plan. So what do? You know how what are you doing right now by maintaining financial records. Now to from that you create your personal financial statements like cash flows, which gives you where you're getting your income from and where you're spending. Then you have balance sheets. Balance sheet means what are your assets, what is that you own today, and what is that you owe today, that is what are your liabilities. So where are you situated, how much do you have, and how much do you owe. So that is balance sheet. Once you have created these two statements, you have a fair idea of what you are doing till now. From that you create a budget. Now budget is your expectation. of your expectation of how much income you will get, your estimate of how much income you will get, what is your savings plan, what are your expenses that you are going to spend. Okay, so budget is a future estimate. A system for personal financial records. It is an organized system of financial records, provides a basis for handling daily business affairs, including paying bills on time, planning and measuring financial progress, completing required tax reports, making effective investment decisions, and determining available resources for current and future buying. So records are important for that. Many records are kept permanent. So birth certificates, wills, property papers are almost kept permanent. Property and investment records are kept as long as you own. So if you are selling a house, you if you have sold a house, you don't need the records for that. So you can disown them. Otherwise, they are kept until you have those assets. And there is important thing, all your tax records, all your tax filing statements, you have to keep it by law for 6 years, because audit can go at max 6 years behind. So it is important to keep your tax records for 6 years. So here is a list of items to keep in your home file as you refer them often. So personal and employment records you have to keep. Home file is, you can keep those records in physical copies in your drawers and in your cabinets, or you can keep those records as digital copies in your computers. So records that you can maintain are personal and employment records. So what is your birth certificate, where what is means where is your passport, or the passport that you have, or any other relevant documents that you think is important, as well as an employment records like your offer letters and your experience certificates and all those things. Then tax records, as we have discussed, you have to maintain tax records for at least 6 years. Financial services record, so what are your banking statements, quarterly statements, monthly statements, annual statements. Money management record, so your we'll discuss what is money management, but your cash flow statements as well as balance sheets. Your credit records, the loan documents if you have taken any loan. Consumer purchase and automobile record, so if you have made any consumer purchases, so regarding that. Insurance records, purchase of insurance, the insurance deed. Investment records, housing records, estate planning, and retirement records. So all these records you have to maintain. Option is either you maintain it in physical copies or you can have it in digital copies. Now, the problem with keeping important documents at home is possibility of theft. So you can use safety deposit box that are available with banks. So safety deposit box is a private storage area in a financial institution with maximum security of valuables. So generally use it to keep important documents that are hard to replace, like birth, marriage and death certificate, citizenship and military papers, adoption, custody papers, serial numbers and photos of valuables, GIC, mortgage papers, insurance policies, coins and collectibles, and copy of will. So advantage of keeping it in safety deposit box is there is more safety there. It is the possibility of theft is low. It is still there. Theft still occurs at financial institutions, but it is quite low, because when you go to a financial institution, they generally issue two keys. One, you keep it with you, so even if your key is lost, a thief cannot access your safety deposit box, because the other key is kept with financial institution. Other places to keep records can be automobile vehicle registrations. You can keep it with lawyers, doctors and hospitals, home computers, or digital way you can keep it. But even if you're keeping those records in digital medium, you have to have the necessary firewalls so that your personal information is not hacked. So good antivirus softwares and good firewalls go a long way. So what you don't need, so you don't have to keep financial records infinitely or indefinitely. For example, every month you get your bank statement, so it's not required to save bank statements every month for infinite period. So let's say you're going to have it for current month, you're having the bank statement for current month, you're storing it for last month, you're storing it for the last quarter, you're storing it. But it's not important to have a bank monthly bank statement that is 5 years old or 3 years old. It doesn't serve your purpose. So information that you don't require in future, you can shred it. So you can have a waste bucket shredder, or in digital terms you can have a recycle bin. So whatever you don't require goes here. So this is how you maintain records. From these records you prepare a personal financial statement. So what is a personal financial statement? What is the purpose of it? It summarizes the value of items you own and the amounts you owe. So it indicates what your assets are. Assets are something you own, and what your liabilities are. Liabilities is something that you owe. Tracks your finance cash inflows by source and outflows by type. So cash flow statement has where your cash is coming from, where is your income coming from, and where are you using that income. So your expenses according to the types that they have. It identifies strengths and weaknesses in your current financial situation. It measures progress towards financial goals and provides data for use in filling your income tax returns or applying for a credit card. A financial statement that reports what an individual or family owns or owes is called as a net worth or a balance sheet. So what you own, assets, minus what you owe, that is liabilities, gives you your net worth. So balance sheet has following components. So list the amount of items of value. So whatever you owe, you have to calculate it and note it down. So assets, cash and other properties with monetary values. So they can be liquid assets, cash and items of value easily convertible into cash. So liquidity is assets that are in cash. So whatever amount of cash you have physically, whatever amount of cash you have in your current accounts and savings account, as well as items that can be easily converted into cash, all those are considered as liquid assets. So another important point is there should not be a loss of value, a significant loss of value while converting it into cash. So example, you may have stocks of a company. So stocks, even though they can be converted easily by selling them on market for cash, they are not liquid. The reason is you cannot guarantee that there will be no loss of value. So liquid assets is easily convertible into cash, and second point, there is no loss of value. Then there is real estate, home, condo, vacation property, and land you own, personal possessions, automobile, and other personal possessions, investment assets. So, funds set aside for long term financial needs. So, stocks, bonds, all those things comes in investment assets. Now, with personal possessions, it is very important. So, you may have an iPhone, or you may have an iPad, or a drone, or an car. So you can note these down as your assets. But important point is you cannot have the value at which you have bought them. You need to consider what is the resale value. So even though you bought an iPhone, let's say 10 at a price of $1,500, but when you are selling that iPhone now, because you have already used it, it has depreciated. So you may be able to sell that iPhone today at $1,000. So you need to note that $1,000 as the value of that asset, not 1,500 the price at which you bought it. So this is important in all depreciating assets. The value of asset whose the asset whose value goes down. Then next is liabilities. Liabilities is amount you owe to others. So current liabilities are debt that you have to pay within a year. Long term liabilities are debt that go beyond 1 year. And step 3 is you have now estimated your assets, you have now estimated your liabilities, subtract the two, you'll get your net worth. Component of balance sheets also include a person with high net. Okay, so you have calculated your net worth, so you have estimated your assets, you have estimated your liabilities, and you have a significant net worth. Let's say your net worth is $200,000. So that doesn't mean that you don't have financial difficulties. So a person with high net worth may still have financial difficulties. So he may have no liquid cash to pay current expenses. He has all his money locked into long term assets like, let's say, real estate. He has three houses. So his net worth is high, but he doesn't have money to pay off his current expenses. So it may happen. So in case of that, we call it insolvency. Insolvency is the inability to pay debts when they are due because liabilities far exceed the value of assets, or you don't have money to pay them. You can increase your net worth by, how do you increase your net worth? Increase assets or decrease liability. So increase your savings, so you can buy more assets because savings is a liquid asset. Reduce your spending, decrease your expenses, so you have more surplus cash. Increase the value of your investments and other possessions, so increase the assets that you have, and reduce your liabilities. Net worth is not money available for use but an indication of financial position on a given date. So this is the example. So you estimate your assets, so liquid assets, real estate, personal possessions, and investment assets. You estimate value of that, calculate the total assets that you have, then you estimate your current liabilities. So current liabilities, the liabilities that are due in 1 year, liabilities that go beyond 1 year, add that up, subtract the two, you get your net worth. So a financial statement that summarizes cash receipts and payment for a given period is a cash flow statement. Now we are moving to the second financial statement, that is cash flow. So what does it entail? It entails cash received during the period minus cash outflows during the period, and it gives you surplus or deficit. So this is an example. So income from different cash sources, then from that means you have to calculate the total in hand income. You may have a gross income, but you have deductions like federal taxes, provincial taxes, employment insurance, Canadian pension plan. So you have to deduct all these expenses and you have to calculate the total in hand income that you get. From that you do your expenses. So loan payment, rent, apartment insurance, these are fixed payments. So you have fixed payments like your rent. Then if you have taken any loan, the EMIs you are paying, equal monthly installments on the loan that you are paying. Then any insurance premiums that you pay regularly, all these are fixed expenses. Then you have variable expenses like food, uh, amount you spend on food, amount you spend on clothing, etc, etc. So expenses we grossly divide into two. Fixed expenses are expenses that do not change much over the period of the year, and variable expenses are, they change. Okay, and cash flow statements we do monthly. So expenses that do not change monthly, like your household rent, we take it as fixed. Expenses that change monthly, for example your entertainment may change monthly, so we take it as variable expenses. Once you subtract the two, you get your, sorry for that, you get your surplus, you get what is left. Then you allocate for emergency funds, savings, etc. So Cash flow statements include step 1, record your income. So income from employment. From that we calculate take home pay is earnings after deduction for taxes, and it is also called as disposable income. And this is also important, discretionary income. Discretionary income is money left after paying for basic necessities. So you have your income, the gross income, then you calculate net income because you have to pay taxes, you have to pay employment insurance, etc. From that net income you deduct what is required for you to stay, so basic necessities, not the entertainment and food, eating out and all those aspects. The amount you spend on basic necessities, and whatever is left is your discretionary income. Now if you look at different cities in Canada and their discretionary income, Toronto has the least amount of discretionary income in this country because the expenses are so high in Greater Toronto area. It is followed by Vancouver and Montreal. So compared to big cities, Calgary and Edmonton are quite good in terms of discretionary income. Then savings and investment income, you can have income from savings, investment. Apart from your employment, you can have income from gift, grants, scholarships and educational loan. So you have to note all these incomes down. Government payments, so if you're not working you get employment EI payments. If you are retired you get CPP payments. Amount received from pensions and retirement programs, or alimony and child support payments. So you have to divide your source of income into employment, savings or investment income and other sources. Step 2, record your cash outflow. It will be fixed expenses that do not vary month on month and variable expenses that are flexible. And determine the net cash flow. So income minus expenses gives the surplus or deficits that you have, and then use it for savings, investment plan, etc. So your balance sheet will measure your progress towards your financial goals. Save and invest on a regular basis. Identify how your assets are distributed among different categories. Each asset has its purpose, and calculate your current asset allocation. So allocation of financial assets between cash, fixed income and equity investments. So analyzing financial statements. Now measure your progress towards financial goals. Are you achieving your financial goals? So let's say my goal is to have $1 million in net worth by the time I reach 45. I'm currently 29. So how do I get there? What is my progress? What is my current net worth? So you can measure that progress through financial statements. Identify how your assets are distributed in different category. So once you create a financial statement called as balance sheet, you know how much liquid assets you have, how much fixed assets you have, what is the money blocked in real estate, etc. Calculate your current asset allocation. Means decided between cash, fixed income and equity investments. Identify whether your investments are tax efficient. So whenever you create any assets you have to consider taxes on it. So do you create assets in a tax deferred way? You don't pay any tax right now, but you save some tax by getting a deduction under registered retirement savings plans or etc. But you have to pay tax when you sell those assets. That's one way. Or you do it in a you do it in a tax exempt way. So you don't get any tax exemptions right now for the amount of savings you're doing, tax free savings account for example. But when you sell those assets you do not pay any tax. So how do you decide which asset goes where? Sorry for that. Then identify assets that may be lost, stolen, damaged or destroyed, and you take an insurance on that. So fixed assets or real assets, for example automobile, your house, they have a physical threat because they're physical in nature, so you can take insurance on it. Financial assets you cannot take insurance on, so you cannot have an insurance on your stocks, Identify assets. Okay, summarize the types and extent of your liabilities. So borrow to financially finance depreciating or appreciating assets. So you can borrow money to buy an automobile or electronics, or you can borrow money to buy real estate. Automobile or electronics is a depreciating asset. So if you buy a new car, 1 year from now the value of that car goes down, but value of real estate ideally is an appreciating asset. So are you borrowing your money for buying depreciating assets, or are you borrowing your money for buying appreciating assets? You can see it from that. Many credit cards may inflate your debt ratio. So having a decent amount of debt, not going beyond your means, is important. Compiling your latest cash flow statements will highlight your sources of income, reveal whether you are overspending, helps you access spending and saving patterns. Now, these are certain ratios that are important. Of these help you to analyze financial statements. So the first ratio is debt ratio. So it is liabilities divided by net worth. Liabilities is debt that you have, the total debt that you have, and net worth is what is left after deducting assets and liabilities. So it shows relationship between debt and net worth. Okay, lower this ratio, better it is. So if you have lesser liabilities and higher net worth, that is ideally good. Current ratio is liquid assets divided by current liabilities. A high current liquid asset means assets that can be converted easily into cash, and current liabilities means liabilities that are due in within a year. So it means how can you use your liquid assets to pay off your current liabilities. A high current ratio is desirable because then you have more assets to pay off your liabilities. Liquidity ratio is liquid assets divided by monthly expenses. So it indicates the number of months in which living expenses can be paid off if any emergency arises. Debt payment ratio is monthly payments divided by take home pay, indicates how much or a person earning goes towards debt payment. So let's say you have $6,000 as monthly payments and your take home pay is 4,000. So it indicates that $2,000 is going towards debt payment after debt. Savings ratio, amount saved each month divided by gross income. So ideally it is recommended to save at least 10% of your income. So we have recorded our financial statements, we have created our we have recorded our financial, or we have recorded our personal statements like banks and bank statements, etc. From that we have created our financial statements, we have analyzed it using different ratios. Now we are going to budgeting. So budgeting is a specific plan, so it's a future plan for spending income. The purpose is spend less than your income. That's a key role. Don't go beyond your means. Understand your sources and uses of cash so that you can control them. Prioritize and attain your financial goals. Prepare for an emergency fund and develop wise financial management habits. So budget is a specific plan for spending income for a certain lifestyle. So lifestyle may be influenced by career. Your job situation influences the amount of income, the way you spend your leisure time, and even the people with you whom you associate. So the expenses that you have, it is not in isolation. It is dependent on your career, family, and values. So family is size of household. So if you have a large family, your expenses will be high. If you have children, if you do not have children, that determines where your expenses will go. Values, ideas and beliefs you regard as important, so your interest, the activities that you like, etc. So I may be an outdoorsy person, so I like hiking, skiing, so your expenses will go towards that. If you're an indoorsy person, so you won't have expenses like that. So steps involved in budgeting process are given below. setting financial goals, plan for future activities that require you to plan your spending and investments. So how do you create a budget? First, create financial goals. So financial goals we have seen should be smart, specific, realistic, stated in measurable terms, have an a definite time frame, and imply action to be taken, so they should be actionable. Step 2 is estimating income. So once you know your financial goals, estimate your income. So estimate available money from a given period based on number of times income received is should be planned accordingly. Difficult if your earnings are seasonal or your income is variable. So let's say you're working in a fixed job in which you get a monthly salary, then it is easy to estimate your income. But you're not working in a relatively fixed job, you're working on commissions, you have your own business, then it is a bit tricky to estimate incomes. Budgeting emergency funds and savings. It is recommended that you need to have 3 to 6 months of living expenses for unexpected expenses and future security. So you need to save 3 to 6 months of your monthly expenses in a liquid form, in a liquid instrument. Step 4, budgeting fixed expenses will depend on your current needs and plans for future. Step 5, budgeting variable expenses. So we are budgeting emergency funds and savings. How are you allocating towards emergency funds? How are you allocating towards savings? Then you're going to have fixed expenses. What are your fixed expenses and what are your variable expenses? So step 1, goals. Step 2, estimate your income. Step 3, have a savings and emergency plan. Step 4, budget your fixed expenses. Budget is forecast your fixed expenses. And step 5, budget your variable expenses. Step 6, now you're budgeted. Budgeted are not actual. Budget is an estimate. Now your actual figures may be different. So your actual salary may be different. Let's say you have allocated $200 of insurance premium. That may be different. Actual premiums may be different. Or you may have allocated that you're going to spend $1,000 on food, but you actually spent $1,100. So the actual figure may be different than the budgeted figure. So you record actual income and expenses, and then you calculate variance. Variance is difference between actual figures and budgeted figures. So if actual figures are more than budgeted, it's a positive variance, or if actual figures are less than budgeted, it's a negative variance. And you calculate deficit. Actual spending exceeds planned spending, or surplus, actual spending less than planned spending. Once you do this, you review spending and saving patterns. So you review, you had planned that you're going to spend $300 on entertainment each month, but you ended up spending $700 on entertainment each month. So there is something wrong with your spending plan. So you have to review and revise it. So successful budgets are well planned. They means they consider everyone who is involved in budgeting. So if you have a family, you cannot just create a budget for the family and enforce them upon that family. You have to make them a part of the planning process. So they are well planned, they are realistic. So you cannot save, let's say, 50% or 60% of your income if you are having a family. So if you plan for that, more or less you would not be able to follow it. So they should be realistic, they should be flexible, because things may change, and they should be clearly communicated. They should be easy to understand for everyone. So why do we save? So common reasons for savings include setting aside money for irregular and expected expenses, earning income from interest on savings for use or in paying living expenses. So once you retire, savings gives you interest, or means any regular means money flow that you can leave, that you can use for your living expenses, replacement of expensive items such as automobile or down payment on a house. You can use savings for that. Buying specialty items like home entertainment, providing for long term expenses such as children education and retirement. Selecting a saving technique should make regular periodic saving deposit, can be a percentage of income. So ideally you should at least save bare minimum, save 10% of your income. So how do you do it? You can either have automatic debit from your account, so that are called as auto debit functionalities. So once it is deposited in your savings account, it gets automatically debited and goes towards your savings plan, towards your investment account. Payroll deductions, direct deposits, and saving coins and spending less. So payroll deduction means you can have a savings plan installed at the point of your employment. You can tell your employer that I want to deduct this amount that goes into my retirement fund, let's say. So you are not paid that amount. That amount is automatically deducted at payroll and it goes to your savings plan. Same way direct deposits, that is auto debit. And saving coins and spending less. So saving coins means whenever you have spare change, you can save that spare change in uh, in some box or something, and you can deposit that spare change, and believe me, that becomes a big amount. And the basic point is spend less to save more. Now if you have a dual income household, how do you manage your budget, or how do you budget it? So one way is to pool your income. So everyone pools in income. So me and my spouse or my better half pools our incomes together. Then from that pooled income we have our savings plan, and then we have our expense plan. But pooling income requires significant amount of trust. Then the other way to look at it is sharing the bills. So there, let's say there are 10 types of expenses, so half of those expenses I take care of and half of the expenses my partner takes care of. You can have 50-50. So each expense, if a person contributes 50-50. And the last way is incomes may be different, so we make proportional contributions. So let's say if I have higher income, I contribute more because my income is high. And if my partner has a higher income, so he or she contributes more. So how does it work? We have a financial goal, we have a savings method, we earn annual interest, and our savings grow. So for example, your financial goal is to set aside $6,000 for unexpected income. So you can make a single deposit from past savings. Your interest rates are 3%. So how it will grow, they have shown that. So this we have seen. So the concept is compounding. If you save, your money grows because of compounding. This we saw it in last chapter. So summary: recognize relationship among financial documents and money management activities, create a system for maintaining personal and financial records, develop a personal balance sheet and cash flow statements, and create and implement a budget, calculate savings needed to achieve financial goals. So this is all we have covered in this chapter.